Well, let's talk about with our financial planners here, Harrison Johnson, CFP. Harrison, thanks for being here. This is something that doesn't come up enough, and we think, oh, it's so easy. But I'm sure the local plumber out there or the local doctor, maybe engineer, they just don't know when you sell your home, there's a way to keep some of those proceeds as opposed to giving so much of taxes.
Well, there's some nuance to it because, if you sell a primary residence versus an investment property, there's different rules. So when you're selling a primary residence, you can exclude $250,000 of the gain component of that. If you're single or if you file a joint tax return, up to $500,000 of that gain. And the rule is you have to have lived in that property and treated it as your primary residence. So you have to own and lived in that property for a combined 2 years in the last 5-year period. Doesn't necessarily need to be the most recent 2 years. Just in any of the last 5 years, was that property your residence, your primary residence, for 2 of those 5 years? And if you can qualify for that, up to $250,000 or $500,000 of the capital gain component of that is then tax free. So,
and it's so important to kind of look at the receipts and stuff. And I'm guilty of this. And I was thinking as I was reading this or reading this, I was thinking, gosh, I had this great guy, friend of yours, Chase, Nick Springer, do the pavers for me. What a great price it was. Do you think I kept that receipt? No. And I might call him and say, hey, Nick, can you give me another receipt? Because it was, I had a lot done. It was like $10,000. Those little ones add up over years, 10,000 here, 5,000 here. And these can really start adding up against to reduce the cost basis of your home.
That would save you $3,500 in taxes, just that receipt. So that's what that receipt is
I'm making
worth.
that phone call.
Well, but you still have to get the appreciation on the property, but
Right.
on top of that,
Yeah. So if there's a gain that exceeds, in your case, $500,000, whatever that gain is taxable. Federal, state taxes. So your point, though, if you do anything to the house, any improvements, you want to keep a record of that, because if you do go to sell, and with property values in California being as high as they are, those receipts might be worth it. So if you can get a federal and state deduction or increase of your basis on the property, it's definitely worth doing that. And a lot of people don't remember, because we're all kind of maybe guilty of that.
And it's virtually almost any capital improvement you do. If you put in a new landscaping, all these things.
It has to be something that increases the value of your property. So a normal repair isn't considered a capital improvement. So
like air conditioning, if my unit breaks and you repair the air conditioning, that's not a capital
It's not supposed to be. I've seen people do it.
but what if you improve it, where you go from just a regular air conditioner to a heat pump efficiency, to where you're actually improving that capital?
Maybe. If you can make the argument that it improves, that this isn't tax advice, so I'd want to look at that. But the IRS definition is something that substantially, improves the value of the property. So, do with that what you will. But I've seen people write off everything. So,
what about a kitchen remodel?
Oh yeah, absolutely.
That's done a lot.
That definitely does. So adding square footage, adding room remodels to kitchen, bath, all of that stuff, pavers, redoing landscaping, all of that stuff you could say is improving the value. And you want to keep those receipts, because again, if the gain when you sell the property is greater than $250,000 or $500,000, that extra amount is reportable, and those receipts can help offset that. Also, to keep in mind, your mortgage or any loans that you have against the property have no bearing on the basis or the gain. Some people think, well, my house is $1 million and I have a $700,000 mortgage, so that means my gain's $300,000. No, your mortgage has nothing to do with the gain. The gain is what you bought it for compared to what you sell it for. That's your gain, and then that can be reduced by any improvements that you've done, like remodels and things like that. So that's your gain component, and then of that, $250,000 to $500,000 can be excluded.
Yeah, one thing I know we always talk about is, I don't think here, and people are going to disagree with me, but here in California, rentals are worth the hassle with all the risks and the low cash flow that's generally a result of it. And sometimes when people have their home and they're like, I'm going to turn it into a rental, I'm always like, no, you gave up $500,000 of tax-free money.
Yeah. A lot of people will look to do that, and technically, you could move out of your house treat it as a rental for up to 3 years and then sell it, and it still qualifies because in that 5-year period, the first 2 of those, it was still your primary residence. But the exclusion then only offsets the appreciation that you've had for the life of that property. When you rent a house out, you start to claim depreciation, which is a tax benefit to go offset the rental income that you have. But when you then sell it, any depreciation that you've claimed is what's called recaptured, and that is taxed. That depreciation recapture cannot be offset by this exclusion when you sell a primary residence.
Yeah, to me, if you're selling your primary, I don't think I would. I mean, I would never do a rental here in California, but definitely would never do a rental if it was my primary residence.
Well, that's another thing people mix up too, because with investment properties, that's where people look at 1031 exchanging and things like that. Because if you sell an investment property, you can replace it with another investment property through a 1031 exchange. So then you defer all of that gain into the next property, and there's some rules that you have to follow and everything, but you can push that gain into the new property. Where with a primary residence, you don't have to do anything with the proceeds. Whatever the proceeds you get, some people think you have to buy a new house with it. No, you don't. You can do whatever you want. So you can spend it, invest it in something else. It's either the exclusion for primary residences or 1031 exchange is for investment properties.
And this is where the fee-based planner is so important, because someone should, before they do anything, give you a call up, say, Harrison, I'm thinking about selling my home. What's going to be the tax consequences? And you can do that. You can give them all these ideas. Chase, you brought up an idea. Maybe in California, not a good idea to rent your home out. I mean, so many things to have a conversation. That's the difference between a fee-based planner and somebody that's trying to sell you mutual funds. They probably just won't do very much.
An example of that is, we're getting close to the end of the year. A lot of times when people are thinking about this is because they are retiring and then going to be moving. So let's say you've worked all of 2025 and then you're looking at selling your house. Well, if you're selling your house in 2025, that potentially taxable capital gain is a part of this tax year in addition to the other income you had from your job. But if you're retiring, that means, we're almost to 2026. You're not going to have as much income in 2026, likely because you're not going to have wages. So if you sell your house, in January, now whatever portion of that gain, even if there is some taxable income that's in 2026, if you don't have a lot of other income, that taxable part of that gain could be in the 0% tax bracket in 2026, where it might be in the 15 or the 20% bracket in 2025. So the timing of how you do this has a huge impact as well.
Right. I want to walk back something real quick. I know we're going to move on to companies, but the only time I would say it makes sense to rent it out is if you move states. If you move out to, let's say, Florida, and then you're like, I've never lived in Florida. Well, actually, it might make sense to rent your house out for a year, just in case you hate Florida and you're like, I want to move back. You still have that 2-year grace period. That, in retrospect, would be worthwhile.
Yeah, because I think you said, Harrison, it's 3 years, so you can.
So it's of that 5 years.
Yeah.
So yeah, if you move somewhere for a couple years and then you decided to sell, great. If you want to move back, you could. In that case, depending on where the house is located, a short-term rental might be better. So you're not, you don't have quite the risk of tenancy laws and squatters and things like that. But yeah.
So I take it back. Rentals can make sense, just very rarely.
Got to talk to your financial planner that knows your financial situation first before you make those decisions. So Harrison, thank you very much. We appreciate it. Again, that is Harrison Johnson, CFP. He is the financial planner at Wilsey Asset Management. If you want to have a free consultation with him, give him a call at the office. 858-224-0004. Again, that's 858-224-0004. Or go to the website smartinvesting2000.com. That's smartinvesting2000.com. And you can send an email and set up for that free consultation.